Very good afternoon, all of you. Hope you all are doing good. May blessings be upon you all. Myself, Praveen Singh Chauhan. I welcome you all to Commerce Online Classes. As you all know, we have designed 21 days program for all those students who could not get through their intermediate second year exams in commerce. Okay. To begin with, let me apologize for a delay because of some technical reasons. Okay. Now we have designed this 21 days program in such a way that we guarantee you will definitely get through if you religiously follow all this, what is said in the classes, and do religiously attend all the 21 days classes. Okay. So without wasting much time, I'll directly come to the topic. Let us first discuss the weightage of the topics. As you know, commerce, we have two parts. We have two parts. One is part one, that is theory, and part two, that is accountancy. Isn't it? Theory, somehow you'll be able to manage by learning, by cramming the answers. The one area where you actually face problem is the accountancy part. So what I have decided is for the first 2 weeks, we'll have all the topics in accordance with the weightage in the IP paper. We'll be following accountancy for 50 marks, as I said, in accordance with the weightage. Okay. So the topics what we'll be covering is, like, sir, the topics what we'll be covering is depreciation, having a weightage of 5 plus 2, that is 7 marks. Then not for profit organization, not for profit organization. This is having a weightage of 10 plus 5 plus 2 plus 2, that is 19 marks. And then lastly, we have partnership, having a weightage of 20 plus 2 plus 2, that is 24. Okay, this is how we are going to cover our 50 marks. And I request all the participants daily when we are in the class, you please be ready with your textbooks as prescribed by the IP Academy books and one notebook. Okay, so without wasting much time, as I said again, I'll start the topic depreciation. We are starting with depreciation. In the first year, you have learned about fixed assets and current assets, right? Fixed assets and current assets. I'll take few examples of fixed assets. I'll give very simple meaning of fixed assets. The assets which are held in business for more than 12 months. The assets which are used in business for more than 12 months are called as fixed assets. More than 12 months. They are called as fixed assets. Okay. And these fixed assets, let's just say, for example, plant and machinery, or let us say furniture. These are the assets which, when used in the business, do get deplete or do get decrease in the value of in the basic value because of certain reasons like wear and tear, economic reasons, or affliction of time like that. So depreciation is a gradual and continuous diminution in the quantity, quality, or value of an value of an asset. Well, this is the definition given. What is it? Depreciation is a gradual and continuous diminution in the quantity, quality, or value of an asset. So every business concern, according to conservatism concept, has to provide for depreciation. While calculating depreciation, there are three factors which are to be taken into consideration. There are three factors taken into consideration for the calculation of depreciation. First one is cost of the asset. First one is cost of the asset. Second one is estimated useful life. And the third one is estimated scrap value. I repeat, there are three factors taken into consideration for the calculation of depreciation. One, it is cost of the asset. Second, estimated useful life. And thirdly, it is estimated scrap value. I request you all to take a note of these key points, please. Okay. So now what does cost of the asset mean? Let us say there is A Limited, a company in Hyderabad. It had purchased plant and machinery in Mumbai. Okay. There is a company by name A Limited in Hyderabad. They purchased the plant and machinery in Mumbai. Let us say the cost of the machine is 20 lakhs. So this 20 lakhs is cost of acquisition. This is cost of acquisition. But then, obviously, it has to be brought to Hyderabad. So, in bringing it to Hyderabad, let us say they paid 50,000 rupees as transportation charges, right? And then, after getting it to Hyderabad, they have to install it. So, they paid some amount to technicians or engineers. Let us say they paid another 30,000 rupees to engineers for installation. So, in this case, when I say cost of the asset, I simply don't mean 20 lakhs. I have to take these two also into consideration. And I would say 20 lakhs 80,000 is the cost of the asset. Okay. So when I say cost of the asset, I mean the purchase price and the expenses incurred to bring it to the current location and workable condition. Right? I repeat, cost of the asset means purchase price and the expenses incurred to bring it to the current location and workable condition. So in that case, the cost price is 20, transportation charges 50, and installation charges. Installation charges are another 30,000. So we say the cost of the asset as 20 lakhs 80,000. Right? It is not 20 lakhs, it is 20 lakhs 80,000. So any expense which is incurred, right, before the asset is ready for use, all such expenses, what we do is we capitalize them. That is, we add them to the cost of the asset. Right. Then coming to estimated useful life. Normally, any asset cannot be there with us for the throughout our life or throughout the life the business runs. There has to be a time where it breaks down. Okay. So normally it is said about vehicles, no? Two-wheeler has a 15 years life, a four-wheeler has a 10 years life. It means it is the useful life of the asset. So this estimated useful life will be calculated out of our past experience. Right? How do we calculate this? We calculate it out of our past experience. Right? It is not exact life. Remember, it is an estimated life. It can be either 1 year more or it can be 1 year less. Okay. In the same manner, estimated scrap value. Let us say I purchased the machinery for 50,000, or let us I purchase it for 50,000, and its estimated useful life. Its estimated useful life is, let us say, 5 years. Right? After 5 years, if I sell it, I will definitely realize some amount, isn't it? I'll definitely, even if I sell it to a scrap vendor, I'll definitely realize something. Let us say I'm realizing 5,000 rupees. Then this 5,000 rupees is called as estimated scrap value. It is called as the estimated scrap value, or we also call this scrap value as obsolete value, or we call it as salvage value, or we call it as residual value. So, what is estimated scrap value? It is the value that an asset realized after its useful life. Okay, so these three factors are important for the calculation of depreciation. Depreciation, I repeat what it is. It is a continuous and gradual diminution in the value or quantity or quality of an asset due to several reasons. Okay. Then, how do we calculate depreciation? The formula to calculate annual depreciation is equal to cost of the asset, cost of the asset minus estimated scrap value whole divided by estimated useful life. You take a note of this, please. Annual depreciation is cost of the asset minus estimated scrap value divided by estimated useful life. Let us say, for example, Messrs. Alpha Traders, Messrs. Alpha Traders purchased machinery for rupees 80,000 and spent rupees 5,000 for its installation. Its useful life is say 5 years, and estimated scrap value is, let us say, rupees 15,000, right? So see, what is the cost price? It is 80,000, and how much amount they have spent for installation? It is 5,000. So in this case, when we say cost of the asset, we would take 85,000. Okay, the purchase price and the installation charges, we add those two and we take 85,000 as the cost of the asset. Then estimated scrap value. Okay, after 5 years of use, if you are selling it, we are realizing 15,000. Okay, we are realizing 15,000 and its estimated useful life is 5 years. So if we apply it in the formula, annual depreciation is equal to cost of the asset, that is 85,000 minus estimated scrap value is 15,000 whole divided by the life, it is 5 years. So 80 minus 15 is 70,000 divided by 5. It is 5 ones are 4. So annually, we have to provide depreciation of 14,000 for 5 years. Okay, 14 for the first year, second year, third year, fourth year, fifth year. Right? This is how we calculate, and you get this for 2 marks. In your IP finals, this is a question expected for 2 marks. Okay. Then we would be sharing all these notes with you. After the classes, we'll be sharing these notes with you. Let us take one more example. Let us say cost of the asset is let us say 1,25,000. Estimated scrap value is rupees 25,000 and estimated useful life is 5 years. Right? So how do we calculate annual depreciation? Annual depreciation is equal to, what is the formula? Cost of the asset minus, I'll write it here again, cost of the asset minus estimated scrap value whole divided by estimated useful life. Okay, if you substitute it, what is the cost of the asset we have taken? 1,25,000. So 1,25,000 minus estimated scrap value is how much? 25,000. Whole divided by 5. So it is 1,25,000 minus 25 is 1 lakh. Whole divided by 5, it is rupees 20,000. So annual depreciation is rupees 20,000. Okay. Hope you all are following this. After the end of the class, the last 5 to 10 minutes daily, we'll be having interactive sessions where you can ask your doubts, but not today. From tomorrow onwards, we'll follow this without fail. So as I said, after 50 minutes of the class, we'll be having a interactive session. Okay. Then, as I said, this is for 2 marks. Then what is asked for 5 marks? Well, there are different methods. There are different methods of providing depreciation. There are different methods of providing depreciation. Around 10 to 11 methods are there, but for your syllabus, you have only 2 methods. First one is called as original cost method. The first method is original cost method. This method is also known by the name fixed installment method. It is also known by the name fixed installment method, or it is also called as straight line method. Straight line method. Okay. So this is one method known with 3 different names. I said for your syllabus, you have 2. One is original cost method, and the second one is written down value method. Written down value method. Again, this is also known by 2 another names. It is also called as diminishing balance method, or it is also called as reducing balance method. Right? So, as I said, there are several methods for providing depreciation, but for your syllabus, we have only 2. One is original cost method, which is also known by the name fixed installment method, straight line method. The second one is written down value method, which is also known by these 2 names, diminishing balance method and reducing balance method. Okay. Then, moving forward, let us learn each of this method in detail. Okay, what is the difference in straight line method and diminishing balance method? That we'll understand. Straight line method and diminishing balance method. Okay, we are trying to evaluate, we are trying to see what is the difference between straight line method and diminishing balance method. Let us say under both methods, we are providing depreciation at the rate of 10%. at the rate of 10%. And we have purchased the asset in the year, let us say 2015. The cost of the asset was, let us say, rupees 1 lakh. What I am trying to explain you is, what is the difference between straight line method and diminishing balance method? So what is the cost of the asset? It is 1 lakh. So as per straight line method, if you provide 10% depreciation, this at the year end, it would come to 10,000, right? How did I get this 10,000? It is 1 lakh into 10 by 100, that is 10,000, right? So 1 lakh minus 10,000 would give you 90,000. This 90,000 for the next year is called as return down value method, or we call it as the book value for the year 2016. Again, in the year 2016, we have to provide depreciation. We again calculate it on 1 lakh. That again would come to 10,000 only. So now the return down value is 80,000. Again, in the year 2017, if I have to calculate, I again have to calculate it on the original cost. That would come to 10,000. So the return down value would be 70,000. See this? What am I doing every time? I am calculating the depreciation on the original cost. If you remember, I told you one name for this method is original cost method. That is, under this method, we calculate depreciation throughout the life of the asset on the original cost only. The cost at which we have acquired, we calculate on that cost only throughout the life of the asset. That is why this is also called as original cost method, right? Now let us come to this diminishing balance method. And I also told one more name for this, that is return down value method. Return down value method. Now let us see. For the first year, we will calculate on 1 lakh only, we'll get 10,000, right? Under diminishing balance method also, for the first year, we calculate depreciation on the original cost only, and we arrive at 90,000 as the return down value for the next year. Now here, what were we doing? We were calculating depreciation every year on original cost only. But under diminishing balance method, we will calculate it on 90,000. So this year, I will calculate it on 90,000 into 10 by 100, which would come to 9,000. Right? So here depreciation would be 9,000 and my return down value would be 81,000 for the next year. See the difference? Here we were getting 10,000 as depreciation for the first year, 10,000 for the second year, 10,000 for the third year. But if you can see here, we got depreciation as 10,000 for the first year, 9,000 for the second year. Reason being, I have calculated depreciation on this value, which is called as return down value. Let us see for the third year now. What is the return down value for the third year? It is 81,000. So here I would calculate on 81,000 into 10 by 100, that is 8,100. So here depreciation would be 8,100 and the return down value would be 72,900. See the difference? You will be easily able to relate it. Here, every year we were providing 10,000, 10,000, 10,000. But here, first year 10,000, second year 9,000, third year 8,100. As we go down the line, every year the depreciation value will decrease. That is why it is also called as diminishing balance method, or we also call it as return down value method, because every year we are calculating depreciation on the return down value. Okay. Okay. So with this, I'll conclude for the day. We'll continue from here in the tomorrow's class. And I again request you all to please be ready with your textbooks and notebooks, please. Okay.